Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Quick tax fact. With intangible assets, the tax result often depends more on when you bought them than what you bought. The corporate intangibles tax regime sets out how UK companies are taxed on intangible fixed assets. These are non-physical assets such as goodwill, intellectual property, licenses, rights, and similar assets. The regime mainly applies to intangible assets created or acquired by companies on or after 1st of April 2002. Before that date, there was no single, harmonized tax regime for corporate intangibles. The purpose of the regime is to align tax treatment more closely with accounting treatment. In general, debits and credits recognized in the accounts are followed for tax, but with specific statutory adjustments and restrictions. This alignment reduces mismatches, but it also means that accurate accounting records and asset histories are essential. Most intangible assets used by companies fall within the regime, but not all expenditure qualifies. Some assets are fully within the regime. Some are excluded entirely. Others are excluded except for specific income streams, such as royalties. Whether something is an intangible fixed asset depends on the nature of the asset and whether it meets the statutory definition for tax purposes. The date an asset was created or acquired is critical. Broadly, assets created or acquired on or after 1st of April 2002 may fall within the regime. Assets created or acquired before that date are usually outside it. Where expenditure spans before and after that date, the cost may need to be apportioned on a just and reasonable basis. Special rules apply where assets are acquired from related parties or assets consist of internally generated goodwill. Acquisitions from related parties are subject to additional rules. Before 1st of July 2020, the key question was often when the asset first entered the group from an unconnected party. From 1st of July 2020 onwards, the acquisition date is usually the date the company acquires the asset. However, different rules continue to apply for transfers within the same capital gains group. Because the rules have changed over time, confirming an asset's full ownership history is essential. Goodwill and other customer-related intangible assets are subject to special restrictions. Although these assets may appear in the accounts, tax relief for debits is restricted or denied in many cases. Whether relief is available depends on the date of acquisition or creation, the nature of the asset, and the legislative rules in force at that time. This is one of the most complex areas of the corporate intangibles regime. As a general rule, tax follows the accounting treatment of intangible assets. However, statutory adjustments can apply, and companies may sometimes elect to write assets down at a fixed rate instead of following the accounts. Whether debits and credits are treated as trading or non-trading depends on how the intangible asset is used within the company. Where intangible assets are held or transferred within corporate groups, special group rules apply. Degrouping charges can arise when a company leaves a group. Relief may also be available where intangible assets are sold and proceeds are reinvested in similar intangible assets. There are also specific reliefs for transfers that occur as part of reconstructions or reorganizations. HMRC has identified recurring problem areas. These include failure to correctly identify intangible assets, claiming goodwill relief where no business was acquired, incorrect acquisition dates, lack of independent valuations, especially for related party transactions, and inadequate documentation. Because the regime is date-driven and history-driven, good records are essential. In summary, most corporate intangibles fall within a single tax regime. Dates and asset history are often decisive, goodwill is subject to special restrictions, and group movements can trigger additional tax consequences. Understanding these principles early helps avoid costly errors later. This brings us back to the fact we opened with. For intangible assets, the tax outcome is often driven more by when the asset was acquired than by what the asset actually is. That is why dates, group history, and documentation are central to the corporate intangibles tax regime. I asked my accountant if Goodwill was tax deductible. He said only if the tax law likes your personality.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.